If you own physical silver, you've probably noticed the limitations. It doesn't move the way financial assets do. And the price you see online isn't always something you can act on directly. That's not accidental, but it does leave a question. What does handle the things that physical ownership doesn't? The first limit you encounter with physical silver isn't risk, it's friction. You can't move in or out quickly. You can't adjust position size easily. And between dealer premiums on the way in and on the way out, the spot price you see online usually isn't the price you pay or get in the real world. That's fine when ownership is the goal, but it leaves a gap if what you want is simple exposure. And that's where silver ETFs come in. ETFs remove most of that friction. You can buy or sell instantly. You can easily resize your position. And you're dealing with market prices directly, without worrying about shipping, storage, or dealer spreads. That doesn't make them better than physical silver. It just makes them better at a particular job. So for me, ETFs aren't about ownership at all. It's about the flexibility that physical metals just don't have. The next limit that physical silver runs into isn't friction, it's leverage. When the price of silver moves, the physical metal moves one for one. There's no built-in way to amplify that move. And that's usually fine, unless you're looking for more upside than the metal itself can give. And that's where mining stocks come into the picture. Mining stocks add leverage to the silver thesis. Not through the metal itself, but through the businesses that produce it. Their costs are relatively fixed, so when the price of silver moves, it can have a much larger impact on their margins. That doesn't make them a replacement for physical silver, it just means that they're designed to respond differently. They can add upside, but they come with business risks that physical metal just doesn't have. For me, the miners aren't about safety or permanence. They're about amplifying the moves in silver. The last limit that physical silver runs into isn't friction or leverage, it's time. Physical silver doesn't care when something happens. You can hold it for years, and in fact, that's kind of the point. But sometimes people aren't just thinking about what might happen, they're thinking about when something might happen. And that's where options come into play. Options are different because they force you to care about when something happens. You're not just saying, I think silver goes up. You're saying, I think something happens within this period of time. And that makes them powerful and risky. Unlike physical silver, they come with an expiration, and they can expire worthless. They're not about ownership, and they're definitely not about permanence. They're about timing. For me, options aren't something to graduate into. They're a tool to be used carefully, if at all. So for me, physical silver is the anchor. ETFs remove friction. Miners can provide upside. And options introduce time. None of these replaces the other. They just solve different problems. You don't need all of them. You don't need any of them. But understanding what each one is actually for makes it easier to decide what does and doesn't belong in your own strategy. And as always, thank you for watching. My name's Kevin. This is Ounces and Options.